This is Keith Edwards, the technical consultant for Red Cloud Klondike Strike, and this is our first monthly podcast. We're going to look at a few things in the marketplace and just give you a bit of an idea what we're seeing from a technical perspective and provide you with some encouragement and a few names that I think look rather interesting right now. There's actually a lot of things happening, but these will be a half a dozen or so that sort of stand out to me. First of all, the title of this is called Transitional Interplay, and that's because my view was that the market began a corrective phase in January of a roughly 16-month advance that started in 2016. That rally peaked in January, and we began a corrective phase of that. And one of the observations I've made is that the idea that you had a 16-month move to the upside, almost, unrelenting, you are not going to basically correct that in a month or two and then turn and go ballistically back to new highs, which I find the media is just very much attached to. I think we are transitioning just the same way as we transition from the winter season to summer. We're seeing a similar transition appears to be unfolding in the marketplace. And where this kicks in my view, is I hear many economists argue that we are entering the late stages of the economic expansion. They're having a lot of difficulty keeping the numbers in line with the idea that we're just going to keep booming forever and ever. It's not going to be that way. So we're beginning to transition. We're beginning to move more towards paying attention to more economically sensitive sides of the market, and particularly into the materials and the commodity side. Now, part and parcel with this is that we have reversed the 37-year downtrend in interest rates. They're arguing, even this morning I heard them arguing, that this is not a problem. This is changing the whole game, because for the first time in 37 years we are going to see interest rates working their way higher. There's going to be pullbacks and dips along the way, but basically the trend in interest rates has reversed, and we are going to be in a rising yield market going forward. For example, just on the breakout, I opened up targets at 375 to 4 on the 10-year, and beyond that, 675 to 7%. So this isn't going to just disappear as a lot of them think. Now, at the same time, this is sending the US dollar higher, which it should. If you rising interest rates should make the demand for the US dollars go up, and that's exactly what's happening, and that is causing some at least short-term problems within metals and the golds in particular. But underneath the surface, we are seeing inflationary pressures building up. I've run a chart that I've used for many years, and I learned it in Chicago from a trader in the pits, that his view was, here's what we look at when we want to know whether inflation is a problem. And interestingly, that measure turned up in 2016. It's been climbing since there, and it's recently moved to new recovery highs. So what that tells me is all this talk about, we may be getting wage pressures or something. Yes, you're going to get wage pressures. You are also starting to see, and I heard some comments on television a few days ago from some corporate people saying that they are starting to see their costs going up. And I think this is all going to start to build as we go along over the summer. Now, this is causing the markets to change. We've seen the volatility go up. I think it will stay higher. We aren't, in my view, going back down to 8 and 9 on the VIX. I think we will probably stay higher. Maybe a low on any dip would be to around 12 or something like that. And I think we will get back to a more normalized level of volatility, probably between 16 and 20. And when the market gets in real trouble, we may spike into the 20s or 30s. The other thing that we're seeing is a move to small cap stocks. The R2K, which is the Russell 2000, has broken out to new all-time highs. This is the small cap side of the market. This is in effect the troops are now leading the generals, which is the big large cap blue chip names. But it's really a move towards paying attention to the domestic U.S. economy. And these are a lot of the banks and the regional banks, a lot of smaller companies scattered over the U.S. that are beginning to come to life. They've received nice tax breaks and everything, and they're putting that money to work. Much of the big blue chip side of the market just funnels the tax receipts they got back into buybacks and dividends. But the smaller companies are actually putting the money to work. They're adding facilities, they're adding equipment, and they're developing things. And I think this is changing the way this market acts. And particularly when you go and look at a breakdown of the Russell 2000, you'll see that the industrials and the metals are oversold, and the relative strength is also has come way down and is beginning to just curl and turn up. And we're seeing leadership in there coming out of obviously energy stocks and the financials. And the financials will be the ones financing an awful lot of this and feeding the money out. But it is the industrials and the materials that are starting to take hold in the marketplace and lead the small cap side. I think this also ties right into what we're seeing in the Toronto market. It's obviously being led by energy stocks, but you can see that the industrials and the materials are all starting to act a little better. And I've been surprised somewhat by, we've seen this US dollar make this quite significant move to the upside, which doesn't look like it's finished yet. But in my opinion, the damage has been very contained and very orderly as it typically affects things like the metals and things like that. It has had no impact on energy. So I think that what we are in a transitional phase is moving towards favoring industrials, favoring the material side. And as pertains to Red Cloud, it says that we're going to start seeing, and we are, in my opinion, starting to see a lot of small exploration and junior mining companies are starting to basically bottom out. They've had some corrections since the beginning of the year. They're many of them quite oversold, but they're starting to bottom and they're starting to firm up. But the key, I think, to have here in the next few months is some patience. I think there's a lot of confusion within much of the market about rising interest rates and inflationary pressures. And I think it's going to take a bit of time, which, as I said at the beginning, the whole corrective phase argued that if you went up for roughly 16 or 17 months, if you corrected for roughly 6 or 7 or 8 months, meaning out into, say, August into September, that would be a normal time corrective process. And I think that's really what we're in. So I think if you have the patience, I think you're going to find that you're going to do very well in the coming, say, 5 or 6 months and probably right into the end of the year. So with that, I'll say thank you, and we'll be back for another podcast in a month's time.